And welcome back to the Financially Simple Podcast. I'm your host, Justin Goodbread, and today we're going to continue our conversation about investments for business owners. Today we're tackling one of the probably most commonly used terms in the investment world. We're going to deal with a business owner's view of IRAs and Roth IRAs. What are IRAs or Roth IRAs? Well, an IRA stands for an individual retirement account. A Roth is simply a Roth named after one of the senators who actually created the legislation. In 2019, you and I, if we're under the age of 50 like I am, then we can contribute $6,000 to either an IRA or a Roth IRA. The contribution amount is the same. In fact, if we're over the age of 50, we can put $7,000 into a IRA or Roth IRA. But why? Why would we use one of the over the other? Why is there even an argument about it? Well, with an IRA, if we make a contribution to it, then we get a tax deduction now. So if I put a $6,000 into my IRA on Schedule 1, I think, of the new tax code, we're going to get a tax deduction. If I put $6,000 into my Roth IRA, then I don't get a tax deduction because I have to use after-tax dollars. But in my IRA, if I put $6,000 in there, I get a tax deduction, and the money isn't taxed for a long time until it's time for me to pull the money out, which means that in the future, at an unknown tax rate, I'm going to have to pay taxes on the money that I pull out of the IRA. I see so many people that have $600, $700, million, $3 million in IRAs that have lots of money there that's never been taxed. And so the IRS says, hey, you owe us some money. Give us some money when you start taking the money out of the IRA. And so many times in retirement, people who are living on fixed income, if I use that term loosely, are worried about the amount of money the IRS could require them to pay out of their assets. So along comes a Roth that says, look, you can put the money into the Roth IRA and it's going to grow tax-free because you've already paid taxes on it. And as long as you follow the rules of the Roth IRA, when you use the money from the Roth IRA, it comes out tax-free. You never pay taxes on it. That's pretty sweet. I like tax-free money, like really, really, really like tax-free money. But there's some rules that we have to follow in addition to how much we can put in there. There's also some rules on who can contribute. Well, one of the rules is you have to have a job. So recently our children began working here in the office. In fact, one of them is here today as I record this on a Friday afternoon doing his job. He gets paid, and he could, because he has a job, he could make contribution to an IRA or a Roth IRA. Now, if my child did not have a job that he was gainfully employed at, then he could not make a contribution to an IRA or to a Roth IRA. So one of the rules is we have to have a job. We have to be gainfully employed or have income. Another rule that we have to deal with is if we make too much money, then we won't get deductions for things if we're trying to use an IRA. So underneath the IRA rules, if we make more than $123,000 as a married filing jointly couple, then we're not going to get an adjustment. And it's basically a modified adjustment gross income calculation. So it's a modified AGI or MAGI, M-A-G-I, modified adjusted gross income calculation. That if you make more than $123,000, then there's no deduction. So if we make too much money, we don't get a deduction for an IRA. And if we make too much money, we actually can't contribute to a Roth IRA. So now let's deal with it from a business owner's perspective. If I want to create diversification, one of the things I want to do is to use tax-free income. If I'm using tax-free income in my retirement, then I'm going to need to use a Roth at some point. Sure, I'm going to use a retirement account, something like a 401k, a cash balance, profit sharing, safe harbor, something that's going to create an enormous amount of wealth for me if my business never sells. But I also want to have the ability to set aside a little bit of tax-free income. I want you to picture in your mind's eye a triangle. And on every tip of the triangle, there's a different tax calculation or a different tax category. The first tax category we're going to call is taxable. So if I put money in the bank, let's call a CD at the bank. If I put $100,000 in a CD making 2% or $2,000 a year, that $2,000 a year is going to be recorded this year as taxable interest. And every year I make that $2,000, I'm going to pay taxes on it. That's one tip of the triangle. The second tip of the triangle is perhaps one that's most often used. Is called tax deferred taxable. So tax deferred hyphen taxable. If it's tax deferred, it means I never pay taxes on the money. 401ks come into this category often. 403bs if you work for like a school or municipality. An IRA or a traditional IRA, if you're eligible for a tax deduction, then you put the money in the IRA and you get a deduction. So it's tax deferred. You're not paying any taxes on that money you just earned to put into the IRA. But at some point in the future, as we talked about earlier, you're going to have to pay taxes on the distribution when you pull the money out of the IRA. Thus, the second point in that on that triangle is tax deferred taxable. The third category is tax-free. Now, I love tax-free money. I love tax-free money. The less money I can give to the government legally, the happier I am. This, by the way, it's not that I don't like the government. Well, actually, I don't like the government. I think they're just really, really bad at managing money. In fact, if we managed our households or our businesses the way the government does, we wouldn't be in business and we'd be bankrupt. Hence, I don't like giving my money to the government. But a Roth IRA allows us to grow money tax-free. I.e., so does an HSA. We can grow the money tax-free for particular purposes. So does a 529 plan. We can grow money tax-free for particular purposes. So there's always a reason why we want tax-free money. So if we're looking at that triangle in your mind's eye as you're listening to this, or as you're watching this on YouTube, or if you're going to watch this through LinkedIn, Twitter, whatever it is on the social medias, hey, by the way, if you haven't connected with us on social media, please do so. If you have, shoot me a message. Say, hey, bro, this is good stuff. It encourages me. It also helps me make sense of who the audience is. Back on track. One of the things that a business owner's perspective is I'm trying to grow a business to where I'm going to sell it at one point in the future. So when I sell my business, I'm going to have a significant amount of money in the taxable category. Because many business owners, myself included, are in high income tax brackets, we're doing things that we can try to figure out how to minimize our taxes. So we'll use tax deferred categories. So that's our traditional IRAs, 401ks. But oftentimes we underfund the tax-free categories because they have to pay taxes on it now. I'm of a firm position that a Roth IRA should strongly be considered. But there's some rules we have to follow. So in a Roth IRA, one of the coolest things about it is we aren't required to take the money out when we're 70 and a half. Now, in an IRA, because you've never paid taxes on the money, the IRS basically says, look, dude, when you reach 70 and a half, you got to pay me some money. They're going to force us to take money out. It's like 3.5% roughly. I think it's 1/27th of the account value. In the first year, you turn 27 and a half. I'm sorry, 70 and a half, not 27 and a half. When you turn 70 and a half, we're required to take out like 3.5%. It may be a little bit more. I think it's actually like 3.6%, but we're required to take out some money every year. And when we take that money out, we have to pay taxes on it. On a Roth IRA, we don't. Which means that if we have money into a Roth IRA, it's one of the easiest ways we can give money to our beneficiaries or to our heirs. And they never have to pay taxes on it either. So Roth IRAs are pretty sweet. And if you're disciplined, man, you can rack up some serious cash in Roth IRAs. Now, one of the most popular misunderstandings that I often run into when I'm dealing with young business owners or business owners who are really good at their craft, but never really dealt in this world of investing or deal in the world of tax planning. Many people don't realize that you can make contributions to your 401k or 403b or 457 plan or whatever other plan you're going to put it in, a TSP if you're a government employee. You can place money into your work retirement account. You can also place money into IRAs. You can put them in both locations. So if I'm making less than $123,000, I think it was. Let me make sure on that. I got a graph here that we're going to share on the blog, by the way. Yeah, if I'm making less than $123,000 of modified adjusted gross income, then I and Emily could contribute a total of $6,000 each for this year, 2019, into our IRAs and greatly reduce our tax burden. So we can use the 401ks and we can use our IRAs. So think about this. Between Emily and I, we could put $38,000 in our 401ks and an additional $12,000 between she and I in IRAs, either our traditional or Roth. We can't put them in both. We can do one or the other. Friends, that's $50,000, $50,000. So if we're making $120,000 and we're living frugally, and let's say we spend $4,000 a month, then I could take out of $128,000. I could put $50,000 back and never pay taxes on it, thus dropping my income down to $70,000 in my hypothetical illustration. pay $15,000 in taxes, and still have plenty of money left over. And I am banking some serious cash for my future. So from a business owner's perspective, knowing when and how to use these IRAs or Roth IRAs is paramount. Now, most of the clients, I would almost say all the clients that we have the honor to serve and grow their net worth. Yeah, if you've heard me say it, I want to try to double the client's net worth every 3 to 5 years. That's my personal goal. Can we do it all the time? No, but that's what my personal goal is. So if we can double their net worth every 3 to 5 years, one of the things that I realize is going to happen is their income is going to substantially exceed $123,000 of modified adjusted gross income. That means I can't put money into the Roth IRA. Definitely can't put money into the IRA and get a tax deduction. So there's a concept that I've written about. I wrote a really long article, and we're going to put a link in the show notes of this episode, and we're going to have it linked to the blog called the Backdoor Roth. The Backdoor Roth is a concept that is pretty amazing. So let's lay the groundwork here. We can place the money into a Roth IRA 3 different ways. We can go in the front door. The front door being we make less than the phase-out limit. We don't break the limit. We have an income, and we can make our contribution of $6,000 if we're under the age of 50 or $7,000 if we're over the age of 50. So we can place money into the Roth IRA. That's the front door approach. But there's a side door approach. Let's call it the side window. If I have money in an IRA, no matter how much my income is, get this, I might not even have an income. Let's say I'm retired now. Then I can move money through the side door. I can convert my IRA money to Roth IRA. Now, when I convert it, I'm going to pay some taxes, but from that point forward, the money that's in the Roth IRA is from that point forward tax-free. So if I'm planning on never using the money and I want to leave it to my beneficiaries, then we'll often advise clients, hey, you got more than enough assets. Let's move some of this IRA money over to your Roth IRA and let's invest it as if you were investing at your beneficiaries' ages. Many times that's going to move the portfolio to a little bit more aggressive position. That's going to allow, historically speaking, better returns. Now, we know that past performance is not indicative of future results, and any assertion to the contrary is a federal offense. We know that. So I'm not saying that you're going to make more money by being more aggressive, by no means. But historically speaking, if you have more equities in place than bonds, you typically would make more money. We also can place money into the Roth IRA through the back door. We can go through the back door. What does that mean? Well, remember how I said earlier that if you make more than $123,000 of modified adjusted gross income, then you're not going to get a deduction for your IRA contribution. So what we can do, though, is we can make a after-tax contribution to the IRA. So we place the money into the IRA and we don't get a deduction for it because we can't claim it. But guess what? Once it's in the IRA, we can convert it. We can throw it right into the Roth IRA. So it's called a Backdoor Roth, and I've got an article about it on the blog. We'll put it again in the show notes. If you're like, dude, I've never heard of such. Yeah, this is pretty common stuff. We've been dealing with this now for years now. I bet it's been probably 10 years or so that I've known it. Maybe more than that, maybe 15. It's been a while. Folks, this is pretty common. So that leads to a question then. The ultimate question. Which is better? Is an IRA or a Roth better? I'm going to tell you the answer is yes. Well, that's not an answer, Justin. Come on, man. The answer is yes. Because it's all about the tax. When I was writing my little show notes here, I had that song come in my head. It's all about the bass, right? No treble. And I'm not going to sing because you're like, dude, I didn't pay you I didn't tune in to sing because you sound like a dying goat. So I'm not going to sing. But it really is all about the tax. I went on to bankrate.com and I ran 2 different calculations using one of the most popular calculators out there. And it was intriguing. And there are 2 PDFs that we're going to put a link to on the blog that talk about the calculations. So I ran 2 different scenarios. The first scenario I ran was somebody who is 29 years old. They have 36 years into retirement. Oh, been there. They're only going to make a 7% return. They're currently making about $40,000 a year in income. And because they live in a state that has high taxes, they're paying roughly about a 25% tax bracket or tax burden. Whenever they retire, though, I estimated their taxes are going to drop to about 15%. They're married. If we ran those calculations out, whenever they reach retirement age, roughly they would have in the traditional IRA $919,902. And in the Roth IRA, they would have $903,000. So roughly they're going to have $16,659 more in a traditional IRA than the Roth IRA. But here's where it gets interesting. That Roth IRA money is tax-free. Whenever they go to take it out, they're going to have zero taxes on it. The money in the IRA, they got to pay taxes. And so if they were in a 15% tax bracket and they dripped it out over the years, it basically would drop the theoretic account value down to $767,000. So whenever you look at the calculator, it's like, man, it really makes sense for me to use a traditional IRA. But they went into details in the fine print that, buddy, you got to deal with taxes upon distribution. Just for the calculator's sake, I ran another scenario just for fun. I ran another scenario and said, okay, now I'm 29 years old. I am going to retire in 36 years, but I'm making $110,000 a year at a 50% tax bracket now. And in the future, I'm going to be at a 25% tax bracket. In both of my calculations, I had a higher tax bracket now than in the future. If we were to flip it around and put a tax bracket higher in the future, the results could be different. But in this calculation, all things being equal, I just raised the tax bracket up a little bit. In this case, the traditional IRA had $16,500 less than the Roth IRA. Wait a second, Justin, that doesn't make any sense. Yeah, just by adjusting the adjusted gross income a little bit, because it started entering some of the phase outs, the taxes didn't work the same way today, thus causing an adjustment in the long-term value. I hope you heard what I just said. Just a little bit of a change in the equation today made one of the accounts less favorable. What happens if we made another change? What happens if today you're in a 10% tax bracket or a no tax bracket and you're able to put some money back and you now run it out into the future and you're now in a higher tax bracket, as I believe many of us will be, by the way. I believe right now, well, I don't believe this. I know that we're historically speaking in one of the lowest tax brackets we've been in the United States for a long period of time. What happens in the future whenever we start dealing with these trade deficits, and heaven forbid we pay off student loans or houses or the borrowed goat that we borrowed money for, or tractor loans or whatever else that the government wants to just give away free money for? They're going to have to raise our taxes, which means that our taxes will go up at some time in the future. Now, we may not see it in our lifetime. They may continue to do quantitative easing and all these other crazy things they do to manipulate dollars. But nonetheless, we may pay higher taxes in the future. And if that's the case, the Roth IRA is a slam dunk in the majority of cases. Here's where it's going to get complicated. The Roth IRA is after tax. So if you're in a 20% tax bracket, you must increase your net contributions to accurately compare. Let me explain this. To accurately compare, and this is where the calculators often don't make sense to me. If you're in a 20% tax bracket, then you have to reduce your Roth contribution over your IRA contribution. So let me give you an example. Let's say we put $6,000 into an IRA. That money went in there pre-tax. But now if we wanted to put the same $6,000 into a Roth IRA, we already had to pay greater than $1,000. I'm going to do this in my head, $1,200 in taxes to get $6,000. It's actually more than that. It'd be like $1,400 in taxes. So in order to contribute $6,000 to Roth, we actually had to get paid like $7,400. So I simplified it for my simple brain. I said, okay, if I'm going to put $6,000 into a traditional IRA and I'm in a 20% tax bracket, that means I can only put $5,000 in a Roth IRA. So I ran the numbers out. I said, okay, if I put $6,000 into a traditional IRA and I start funding it at $500 a month for the next 30 years at a 7% interest rate, I'm going to have $662,000 in my IRA. On the other hand, if I have $5,000 going into a Roth IRA, 20% less because of the tax issue, that means I have $416 a month going into the account over the next 30 years at 7%. My Roth IRA is going to have $110,000 less than my traditional IRA. Well, Justin, that is, but you got to calculate the tax on the back end. You're right. So I did that. If we take the money out of the Roth IRA at 4% whenever we retire, we're going to be able to get $22,000 roughly per year tax-free income. Now, if we take the money out of the IRA, which has $110,000 more in it, we're actually going to get about $800 less a year once you factor in the taxes. It's pretty amazing to me whenever you start looking at this. So let me ask you a question now. As all this education I'm trying to spout your way, which is better, the IRA or the Roth? Well, you may argue with Justin, it sounds like the Roth is really good. You know what? Many times it is. Many times it is. But by having a larger IRA account value, I want you to think about some things that you can't control. What happens if you need lending and you have $110,000 more in an IRA account than you did a Roth? What happens if you could get a better loan terms? What happens if you could use it for collateral? What happens if you could use it to purchase another asset? Let's say you wanted to take your whole IRA and go buy a fourplex apartment, and you had $110,000, which happened to put you into a better area of the market than the Roth IRA at $550,000. See, we don't often talk about the goals. We talk about the math, saying, well, Roth IRAs grow tax-free, and I love that about them. And I personally have Roth IRAs that I max out every year, but only after I'm getting my tax burden significantly reduced. So my challenge to you is this: which is better? They're both the same, and they both have different applications. When you look at it holistically, they both work. Neither one of them is going to be detrimental to your net worth. But you can do significant planning by knowing which arrow to shoot at the target, which strategy to use. The IRA will couple differently with some strategies than the Roth will. And the Roth will couple differently with some strategies than the IRA will. And if I haven't confused you completely enough by now, let me simplify it for you. This is what I do day in, day out. This is what a true financial advisor does. They're not there dealing with stocks, bonds, mutual funds. They're looking at your entire life and saying, here is how you reach your goals. And we have to know when to use which piece on the chessboard. We have to know that the Roth is a knight and the IRA is a bishop. And the knight and the bishop have different purposes, but can both be deadly comboed whenever you use them with other pieces on the chessboard. So my challenge to you is this, friends. The IRA and the Roth both have their place. Let's at least max out one of them. I don't care if it's the Roth or IRA. If you're not working with an advisor, hire an advisor that can show you comprehensively how these things work with your business, how backdoor, side doors, how you can couple it for bank financing. I mean, there's all these. You can use Roth IRAs for schools. I've wrote articles about it. There's so many things you could use here. They both are they're different, and one's not better. I guess that's my message. With that, we're going to shut this particular episode down. Look, I know life is hard. I know this finance stuff, Roth IRAs, IRAs. We haven't even got to the 401ks. Holy cow, those are going to get fun. I know it's hard. It doesn't have to be. Let's continue to make our lives at least financially simple. Hey, y'all go out and make it a great day.